everybody. Thanks a lot for joining me on this Tuesday afternoon market recap. I hope you are doing well, no matter where you are located around the world. We have had, once again, another interesting signal set up as at the close on Tuesday. In fact, this week so far, we're seeing really a tale of two signs at this particular point. Let me just explain a little bit further what it is I'm referencing. Have a look at the S&P 500 here. Actually, more importantly, I might jump on over into the NASDAQ. It has been, at least on Monday and Tuesday, a relatively strong start to each of these two trading sessions. We have seen, again, a gap up on Monday. That candlestick, however, although it took out this little swing high over here, the handbrake was pulled effective immediately, right, soon after we saw that original gap to the upside. Again, fast forward or rewind through to today's session as at Tuesday. Again, the markets collectively, they jumped back on up, closing, or at least opening up over 1% to begin Tuesday's session. However, again, the handbrake was pulled, effective immediately in the market. It began, at least to close this opening window, which established itself between Monday and Tuesday, but it also continued through to the opening window that we saw between Friday and, of course, Monday being yesterday. You can see this outside day engulfing candlestick. On the NASDAQ at this particular point, these two candlesticks here, we'll just call this a little spinning top candlestick followed by an outside day engulfing candle, right at, surprise, surprise, the 61.8 Fibonacci retracement area, which is coming in at roughly 8,705 points. At this particular point, it has still held. And what is interesting to point out is that we've had one attempt to get above this level. We've pulled back. This is taking us through to the Tuesday candlestick of last week. Since then, again, and continuing through to the open of today's session on Tuesday, we've pushed back on up. Where to? Into that 61.8% fib. Let me just zoom on out so you can see this ratio just here. And again, we've seen another, right, flat out immediate rejection of this area. This is potentially establishing now a chart pattern being that of an intermediate swing high, that of a double top, which may very well establish, of course, that first subsequent macro lower high that we've been referencing off from, right, the support which is built, taking us all the way back to March 23rd, all right? It's a little bit of a variance, or at least 23rd of March was across the board that definitive end to what has been that first wave of the sell-off, which began in mid-February. But this is, again, a collection of reversal signals which are taking place right at critical areas of resistance. I've already referenced, of course, that 61.8 Fibonacci retracement area. If you pay attention to the longer-term simple moving averages as well on the NASDAQ, you can see that we are finding rejection. Although the 100 is positioned above the 200, price action itself is still finding strong selling and overhead resistance right at this critical long-term simple moving average. If I show you the oscillators as well, you can see that we are naturally, right, very overbought off from the March 23rd lows. So again, these are looking to turn down on the minor level of the trend itself. When you go back out into the macro level, you can see, of course, the divergence, which is continuing to form. Most noticeably and most concerningly is that through the guise of the MACD at this particular point. If I switch on over into the S&P 500, I think this is even more ominous at this particular point for a couple of reasons. First of all, it's the first attempt coming back on up into that 61.8 right percent Fibonacci retracement area. 2,943, right, is that definitive sort of laser focused retracement area. You can see we got the gap up to begin on Monday's session just yesterday. Again, we saw the continuation of that through to the beginning of trade today. However, right, the handbrake was pulled. What we've done is we've created a subsequent higher high on a minor level time frame. What's interesting to point out again is that we're extremely oversold and these are looking to turn down. I've spoken about the candlesticks as well over the past 2, if not 3 weeks, whereby we're still establishing a bunch of spinning top, doji candlesticks, shooting star candlesticks, hangman reversal candlesticks, and this is essentially just the very rough, right, reversal box as to where we would expect at some point these markets to essentially stop, hold, and then ultimately reverse. You can see, if I show you this too on the longer term simple moving averages, yes, the 100 very similar to the NASDAQ. It's still above that sideways moving 200-day simple moving average. But again, you're just getting a confluence area of resistance right around or very close to where we even traded at during the open of today's session as at Tuesday. What we are bound to see, ultimately, if price does even hold around these areas, is to actually see the 100 cross below the 200-day simple moving average, which is a pretty decent segue. And by the way, I was going to say segue into the Dow Jones. I'll get there in a moment. What we have created today on top of that is what we call a bearish piercing pattern. Very close to a counterattack as well, but it is another reversal candlestick. It's not the first time that we've actually seen this candlestick more recently. We actually got this candlestick over here, which was the 7th of April. Again, the markets have tried to push back on up. They are higher, obviously, than where they were on the 7th, but really, it's rather immaterial at this particular point, given, of course, the amount of overhead resistance taking place on all of these closely followed US financial market indices. If I show you this on the Dow Jones a little bit further down the road, so to speak, what we have achieved more recently is the 100 crossing below the 200. And again, it's somewhere between about the halfway point of the 0.5 through to the 0.618 retracement. There is still a little bit of gas in the tank, and we've spoken about this over the weekend, whereby we could envision a scenario whereby the Dow Jones does its best to continue to push back on up. But again, it's just limited based on, of course, the overhead resistance, the confluence of resistance as well. If you wanted to look at this through the monthly exponential moving averages, interesting thing to pick up that as we move towards the final trading session in the month of April, which will be scheduled for Thursday, we are bound to see, maybe potentially if we do see again a continued reaction off from these resistance areas, to actually see the 10 exponentially weighted moving average on the monthly time frame actually cross below that of the 20-day. And again, this is very, very important. It is rather ominous because taking into consideration, right, the first wave of the sell-off whereby we saw collectively these markets sell off more than 30%. We're seeing this first wave of the bounce, right, the natural sort of clinging to hope. A lot of people jumping on board, a lot of anecdotal evidence that probably you can refer to or at least reference as well, people you know, that again, just jumping back into the market right at potentially one of those very critical sort of inflection points in the chart whereby you see, right, the 10 cross below the 20, price action fall below both, and then ultimately take out what will be the March 23rd low. So again, I know this process so far, we're moving into what, probably the 6th week now, whereby we started to see the recovery out of this long lower wick on the monthly candlestick in the month of March. This has now continued through to April. Again, on the Dow Jones Industrial Average, we haven't actually back tested or retested the 10 or the 20 exponentially weighted moving average. But again, we're still a long way actually below where these are currently positioned, which are coming up closer to, say, 25,500 points. On the S&P 500, a very similar type of relationship. This is now the second, right, retest of this area. This week here now encompasses that of two retests, the same to a lesser extent is true on the NASDAQ, even though we are above these two critically weighted exponentially weighted moving averages. But again, you can see the natural reaction so far in the holding of this resistance area, whereby again, we're just seeing again the continued confluence at this particular point, hold through to what will most likely be, right, the end of April. Now, we've just had Google come out, reported their earnings. They took a little bit of a hit today, so to speak. They are up after hours, so we might actually see the markets once again try and at least open, probably for the third time this week, up. But at this particular point, even looking at the stock chart of Google, there's Monday's candlestick and then, of course, today's candle as well, whereby we closed down $38. I think we're up over 50 in aftermarket hours. But again, you can just see these overhead simple moving averages continuing to hold as resistance, even for a stock as important when it comes to the FANG stocks, such as Google as well. We've actually pushed back below the 50 EMA at this particular point. We're below, also I just skipped through this, the 100 and the 200-day simple moving averages. The oscillators, again, are still overextended. They are overbought. And again, it's a very good indication that potentially we're starting to turn down and create a subsequent, right, major lower high for the first time in Google through this, what I at least expect this to be some form of a macro top, a transitional top, which is being currently priced into all of the US markets and also the global markets for that matter as well. It's very rare to see the markets acting as they are. They are still tremendously volatile at this particular point. All you really need to do is just look at some of the pre-market activity before Monday and Tuesday just to get your head around it. But these candlesticks here, they are adding up to some very early reversal warning signals. Again, you're creating that sort of double top on the intermediate time frame, so to speak. We'll see whether or not any of this bearish activity that we've seen really come into the market on Tuesday. We'll see whether or not it has any steam or any legs. But at the same time, I want you to be open-minded. And again, when you're looking at the S&P 500, understand that generally what happens is you get the back test, the critical back test of both the 100 and the 200-day simple moving averages, especially during that of a transitional top. We're still yet to actually achieve that on the S&P 500. Those areas on the S&P 500 are coming up at 3,000 points. So again, although today the high of today's session as at Tuesday was 2,921 points, there is still, give or take, 80 points above, right, where the intra-session high was on Tuesday, where we could essentially push to and then look for that major reaction. However, right, you can see it, of course, more or less play out from these current areas, given of course, the overhead resistance at this particular point as well. Jumping into a bunch of other companies, they are set to report this week as well. Apple's trying to turn down. In fact, it's created a little bit of a a rolling top just here. You can see the neckline developing on Apple as well. Amazon, which has held up very, very well. Again, has been one of the major, sort of the primary beneficiaries of what has been, again, a disruption to general supply chains at this particular point. A lot of people staying home, watching Netflix, buying things on Amazon.com. It's done fantastically well. They are supporting, or at least expected, to report later in the week too. So you can see these two bearish candlesticks. I expect it to be relatively, a good report, so to speak, with pretty decent forward guidance too. But we'll see how the market actually reacts to that. Interesting sort of reactions that you can get to forward guidance too. I'm not sure if they're going to pull it out. I don't think they actually will. You've got Boeing Airlines, which is still continuing to coil. You can see this little sort of descending triangle, even though I don't want to call it. It's really just a resting consolidational type of pattern. Got Baidu starting to roll over as well, which is, again, another stock which is looking quite weak. We've got another hangman candlestick at this critical resistance area on Caterpillar, right? That's reported or is about to report as at this recording. We've got COP trying to push, but another stock that has earnings as well that we can't trade. At this particular time, we've got Disney. Again, the handbrake being pulled right at this critical resistance area. I've recapped Google for you. IBM's trying to get a little bit of a bid. So far, so good. However, if this market does turn down, this is going to be swept up in its way as well. So again, just be patient with these stocks. I know a lot of them, they haven't triggered at this particular point. But a lot of them, even though they have had a pretty nice rally off from the March 23rd lows, right? Mapping, of course, if you just overlay, for instance, Microsoft with the NASDAQ itself, it's almost identical. But you can see, again, very similar to what I just pointed out to you on Apple, is that you've got a high, you've got a lower high now, and you've got really a defined neckline. This is going back to the Wednesday candlestick of last week. So again, you can see the critical inflection points. What I've been focusing on for people in our class and what we do over the weekend is more so the market averages, because if you can get a stake in this, if you can hold these positions long term, and if this is going to be a critical rolling point or very close to a critical rolling point, you can really be very selective, so to speak, in individual companies if you've got the overall market direction correct as well. So again, there is a battle going on at this particular point. I wouldn't say that there is any clear winner. Again, as at the close on Tuesday. However, there are a lot of warning signals. There are sort of breadcrumbs being dropped by a lot of individual companies. Just look at the volume as well, as we have seen the markets push back and up. Volume's trickling out of it as well. When you look at Google as well, for instance, you can just see a lot of these very important stocks and also the market averages. There's just not much real public participation or even accumulation, in my opinion, based on the price action, which is now retraced, probably somewhere between, again, 50 to 0.618, depending on the market that you're looking at, of the first wave of the sell-off. A lot of people naturally becoming optimistic on the market. Obviously, more and more countries are talking about future dates whereby they are going to begin, right, opening up their economies too. But at that particular point, I assume that when people are most optimistic about the future, pretty much that's going to be the high price, which is priced in, which will create, right, some major right shoulders on the overall market indices, and potentially that which is more important, that first macro lower high as well. So it is all of a jigsaw puzzle. It's coming into play quite nicely. It can be confusing a little bit. I understand that for people who, maybe might be getting some information from, other sources or obviously listening to the bullish outlook of the markets as well. The one critical thing, again, that you should be mindful of is that if this is not going to be that of a macro transitional top, the markets themselves, they shouldn't really hold for any sort of given period of time. I'd say 1 week above a lot of these really big simple moving averages. The market that I'm applying this to, more importantly, outside of the Dow and the NASDAQ, is certainly the S&P 500. It's sort of the midpoint between that of some of these extreme ranges that we're seeing in the NASDAQ, and to a lesser extent, or more weakly, so to speak, or to a lesser extent, that of the Dow Jones Industrial Average, which again is still struggling to even come up remotely close. I know it has been in a recovery rally, or what we call a clearing rally or a relief rally. It's still a long way away from these overhead resistance areas. We're still talking, right, 2,000, 2,500 points from current areas, which is significant, all right, given, of course, where the S&P 500 is as well. So again, you're looking at the markets to really break the shackles of what may be, or may very well be, that in retrospect, a sort of a bear market rally, so to speak, or a dead cat bounce. You're looking at the S&P at least coming up above, say, 3145. So you're in that sort of that red zone, the radioactive zone, the place that you want to avoid buying, right? The time to really put risk on, if you wanted to, was all the way down here on the 23rd. Not so much at the current juncture, very late into the month of April, as we're pretty much moving into the month of May. The old saying goes, sell in May and go away. So we'll see whether or not that is true for 2020. but it makes a lot of sense based on just how far these markets have bounced and also the overhead resistance areas. Not to mention, of course, these open windows that, in my opinion, are just screaming out to be closed at some future point too. All right, so that'll leave us as at this Tuesday afternoon market recap. I hope that's helped you all. I know it's hard sometimes to be patient and to remain disciplined, and again, not to be swept up in this FOMO effect. But when this does change, it's going to change very quickly. It's going to happen, and a lot of people are going to be unfortunately blindsided by this. This is just the point where you have to be patient, learn to be patient anyway, and just allow the market a little bit of room, a little bit of market noise until what I assume is going to be the true, right, reveal of the market up and around. If in fact we can get up into these resistance areas any further anyway, whereby we'll just see a flat out rejection, all right, from these current areas. So stay tuned. I'll keep you updated as this continues to unravel, but at the same time, again, be safe, be very smart out there, of course, in the markets too. And I would strongly encourage you, if you're thinking about putting on long directional trades at this particular point, you've missed that opportunity, please reconsider, because it might get, I'm assuming that we're starting to really heat up as we draw closer to some definitive breaks of necklines that we've been talking about over the past number of weeks. All right, if you'd like to learn more, have a look into that pro analysis class as well. Otherwise, I'll see you later in the week for another market update. All the best. Farewell.